Good afternoon, you guys. I don't know if you realize it, after months and months, we have sunshine outside. People are attempting to play frisbee out there on the quad. I can't believe it. So I'm impressed that you're inside here to listen to this talk, and I'm really pleased that Tracy and Caroline thought of me for this opportunity. I don't know what attracted you here to this topic or what. I don't know whether it was the cool title, the super cool title, but I hope that you find this interesting. It's in regards to a book that is coming out on June 2nd. It's about to drop on Amazon and Barnes & Noble and all sorts of things. It's quite exciting for me. It's sort of my first big book. It reflects a lot of my research, and I'm going to tell you a little bit about it. Hopefully I'll make you interested enough that you might want to follow up, so we'll see. We'll start this way. Tell me your name again. Michael. Michael, is the United States an emerging market or a developed market?
That's a development.
You're pretty sure?
Not 100% sure.
Okay. Not 100%. Nothing shy of 100%. What's your name?
Daniel.
Daniel.
Yes.
Germany?
I would say it's a developed market.
Developed market. Okay. Let's see. Picking off everybody here. Caroline, would you say China is a developed or emerging market?
It's kind of both. Because some sectors are very developed, but at the same time it's still progressing.
You're thinking sectors. You're thinking sectors. Industries within China? Let's see. Tell me your name again. Steve. Let's say South Africa. Developed or emerging. Some people use the word developing and emerging together.
Yeah, I'll say emerging.
Okay, definitely in the emerging class. Let's see. Let's do one more here. What's your name?
Zan.
Zan?
Yeah.
Can you guys hear me okay in the back? You can hear me. I'm using my classroom voice. So, Zan. Greece?
I would say that's developed.
Developed. Positive? Like 100%?
No, definitely not.
Okay, so shape. You know Greece has been in the news a lot, right? So, and Brazil?
It's emerging.
Definitely emerging. Okay, so let me just pick off each of you. She mentioned the word sector. She thought of sector when she thought of it. I don't know what you were thinking. You were thinking telco or energy or what, but you were thinking about on a sector basis. So when I asked you about the U.S., it was like you were so sure you didn't think about it. You didn't think about the dimension on which I asked. And I asked you about South Africa, right? What did you think of when I said that? What did you think when you were asked? Where did your mind go? What was the first thing that popped in your mind? But what dimension were you thinking? What element of it? What aspect of it did you think about? Oh, like her.
Yeah.
Like her. You thought about the industries and so on. Okay. So what I'm going to try and do, what this book does, and I'm going to tell you about it a little more shortly, is it tries to put some heft behind this concept of what an emerging and a developed market is. And also, by extension, you can think in terms of a frontier market along these lines. And it's all about, it's not, well, I'll save some more discussion about this, but you know, when you talk to people out there, they think about different elements, different dimensions when they classify countries into one bucket or another. And they're very rigid about saying, well, this is clearly there and this is clearly there. We have commercial vendors in the industry, in the asset management industry, that provide us guidance on this front. This book is written for them and you and all of you to help you solidify your thinking about what we're talking about here. So I've got 4 parts to this. The first part is sort of a warm-up to get you interested, if you aren't already. The second part talks more about the book. Second two parts, actually. And then the last part kind of brings it all together. So if you put up your hand, please do. Feel free to. You can see I'm very comfortable. I hope you see I'm very comfortable interacting, and I hope you feel comfortable putting up your hand, asking a question, stopping me at any point, okay? So here's the warm-up part. Ready? Okay. I call it the phenomenon. Emerging markets in 2013, okay? So look at that picture. Can you see that picture in the back? Can you see it? Okay. So on the top dark line, that's the Morgan Stanley Capital International World Index. It's a cap-weighted, value-weighted index of stocks from all around the world, including emerging markets. And you can, it's heavily weighted towards the more developed markets, like the US, probably represents 30% weight in that, 35% weight in that. And you can see during the course of 2013, that was rocking and rolling. And then down here is a specialized index called the MSCI Emerging Markets Index, EM Index. And you can see this was going in a very different direction during 2013. While this one cumulatively lost about 7 or 8%, we were up at almost 22, 23% in 2013. Now, in case you were wondering whether it's just stocks, which is what I was just showing you, this is currencies. And these are currencies measured relative to the US dollar. And you can see, while there were some among traditionally interesting countries, let's say, that are in the emerging class, some countries did experience some appreciation in terms of their currencies, but the vast majority of them, that's a red color. Red means depreciation. A lot of these currencies were losing value, from the Colombian peso to the Brazilian real, Indian rupee, Indonesian rupiah. And so pretty much anything with the word peso in it is down there, big red bars, big depreciation in terms of the currencies. So that's like a double whammy. Now let me go back to that picture you just saw a second ago, this one. And what I'm going to do is I'm going to lower the microscope here. I don't know if you're looking at that bottom line, there's a special time period in here that's interesting here. And I'm going to move right on in there. This is May-June period. This is really where there was a clear separation of the two markets. And what I've done here is I've broken out the emerging markets into 5 country-specific indices that are really interesting to many people: Brazil, India, China, Russia, and South Africa. And you can see, what can you see here? Is they're all kind of coming down in this May-June period. Somewhere around the 3rd week of May was the starting point, and they're sort of all cascading downwards together here through June. You almost say, gosh, is that a coincidence? I don't know. So you can kind of want you to think about this period of time right here. This is a picture that's out of the Bank of International Settlements. JP Morgan puts out a report on this. There are lots of websites tracking these. These are fund flows. These are mutual funds, for example, based here in the United States. You might hold some of your money in there, or your families do, and they're consciously putting it in emerging markets. And blue means equity, stocks, and bonds are red there, and they're usually stacked on top of each other. And these are monthly numbers here, and you can see that for the last 10 years, you know, ups and downs, right? But if you were to suggest, there's the 0 line there, more up than down in the emerging markets. More people have been putting more money from the US and other large, deep pools of capital, putting it into emerging markets, especially in 2012. There's a couple of bumpy months here, but for the most part, it's been mostly up. And then, that's not a coincidence with that last picture I just showed you. On this single month alone, about $35 billion of money vamoosed out of emerging markets in one single month, coincident with that decline that I was showing you. I mean, it's large, right? That's a large spike. So the exam is coming in about 5 seconds. So you should be thinking about, I'm going to cold call one of you guys to tell me the answer to this question. What do you think happened in May and June of 2013 such that we had this large spike and massive racing to the exits, and obviously coincident with that was the large market declines and currency drops. Volunteer? Anybody? No wrong answers. Come on.
I'm gonna risk
Okay.
it. I'm gonna say.
Please.
Perhaps it has something to do with Greece's default or something with the Eurozone.
2012 was very intense period of negotiations on Greece. Certainly that's sort of in the background there. I don't think it was specific to May and June. That's a darn good answer. Anybody else want to try before I tell you? And I'll give you a hint. It wasn't anything that necessarily happened in any of those emerging markets. Please.
What, did oil prices go up?
Well, certainly that was the start, right? That was the beginning of the decline and softening up in the oil market, the glut in the oil market. Certainly we're talking about that a lot today, right? One more chance with my hint?
Was it
Go.
and the earthquake and
The earthquake, the Fukushima, right? No, that's a little earlier than that. Okay, guys, good try. Cue the Darth Vader music here. Okay. Does anybody know who this guy is?
Yes.
This gentleman is Ben Bernanke, the former chair of the Federal Reserve here in the United States, just down the road here in Washington. He's the chair of the Federal Open Market Committee that basically determines about interest rates. What had been happening? In the years leading up to June in 2013? Go ahead.
I know, like,
Tell me your name again.
I understand.
Daniel, thank you. I'm going to try and
I
remember
know
that.
that like the Federal Reserve would meet in Cheyenne or like when they're
Certainly that's true.
and they would cut interest rates to nearly 0% because of the crisis.
That's right. So the Open Market Committee is basically in charge of monetary policy. They decide about interest rates. Ladies and gentlemen, for the last 6 years since the post-crisis period, we've had interest rates at 0. So they haven't been adjusting interest rates. It's hit the bottom and it can't lower it below 0, practically, right? So what they've been doing to be even more aggressively trying to boost the US economy out of the doldrums was doing something called quantitative easing. You guys heard of that? So this is where they're not only at 0 interest rates, they got their foot on the gas. They're pumping cash into the economy to boost the economy and get employment and investment going. And they're literally buying bonds, printing money, buying bonds to keep not only interest rates low, but just throwing money at the economy to keep stimulating. And what happened this is a really unusual, historically an unusual behavior to engage in. To have the 0 interest rates, flat 0 interest rates, and then on top of that, aggressively buying bonds to keep interest rates low. Very aggressive action, right? So on May 18th, at one of the press conferences following the FOMC meetings, Mr. Bernanke uses the magic word called normalize, meaning we're going to start lifting our foot off the gas pedal here maybe just a little bit because things are starting to look good. Green shoots and positive developments in the labor market, we're starting to add jobs, and he's starting to back off, right? And normalize monetary policy. Well, ladies and gentlemen, that spooked the markets. A gentle little word like normalize spooked the markets such that, now think about this. You're an investor, you're based here in the US. You can put your money into a savings account or a bond where your interest rate that you're going to get on that is nothing. Okay? You're basically almost paying them to hold on to your cash. And let's say you're a large institution, a pension fund, a life insurance company, or any other major asset management firm, and you're trying to make money for your clients, and the current environment is not sustainable, where are you probably going to try and get some yield for your clients? Wherever you can. And one place where they were able to get yield for the years leading up to this was, emerging markets. That's right. And you remember those numbers on flows that you saw every month that were above 0? Well, that's people chasing yield in emerging markets. And it was all fine and good until this guy said, we think we're going to start maybe easing up on this easy monetary policy and start maybe at some point down the line, maybe raise interest rates. So some of that money spiked and came home. And that's all fine and good, except for whom? Who are counting on this flow of funds and saying it's no longer here, it's racing to the exits, causing all sorts of dislocations. So ladies and gentlemen, they call this easing back of the bond buying program the tapering of quantitative easing. And in the aftermath of the announcement that the end of the taper, the end of the bond buying program, or the taper would begin, the tantrums from all over the world started coming in with, evil eyes right on the Fed for causing all this dislocation. This was referred to as taper tantrums. So this gentleman, Zhu Guangyao, Deputy Finance Minister, says, we hope that the issuing country of the largest reserve currency in the world, the country that shall not be named, should be mindful of the spillover effects of its macroeconomic policies, mostly its monetary policies. So it's saying, hey, guys, do you realize what you're doing? I know you're focused on your goals and objectives as you're dealing with your economy and trying to help recovery, but don't be under the illusion that you're not having some spillover impact on the rest of the world. This is out of the China Daily, a nice cartoon. This was at the St. Petersburg G20 meetings, and it's kind of cheeky cartoon. It's the G20 leaders were not supposed to be talking about this, but this is what was happening in September. And you can see it's kind of a cheeky cartoon. You see all these politicians lined up. There's Uncle Sam. And they're all supposed to be playing a nice piano, some sort of concerto here. And he doesn't have the right instrument here that he's playing. He's playing with some other different instrument there, which gives you a sense of it. And not surprisingly, that nice juicy uptick in flows, this is cumulative flows in equity and bond funds now. This is from JP Morgan, Morgan Stanley Research, sorry. It started to take a turn for the worse right here about May, and you can see that cumulatively, though there was a large spike, it was cumulatively exiting. It didn't stop. It went all the way through the summer and the end of the year. And so were the tantrums. This gentleman over here, anybody recognize him? Just testing you guys. This is the governor of the Central Bank of Brazil, Mr. Tombini. He says a lack of coordinated exit from exceptionally loose monetary policy was done at the expense of emerging markets. He's not confused about who he's blaming for the problems that his country is suffering. Right? He knows exactly where it is. This gentleman over here, Raghu Rajan, is the current governor, sitting governor of the Reserve Bank of India. He says, it's much stronger words here, international monetary cooperation has broken down. Industrial countries that have to play a part in restoring that cooperation, and they can't at this point wash their hands off and say, we'll do what we need to do and you do the adjustment. These are not soft words between polite central bank governors. There were strong feelings here. Now, it turns out that some of these countries in the aftermath during the taper tantrums were affected differently than others. And I don't know if you guys can see this in the back. I'm a little worried about this graphic here. But I'm going to start this graphic and I'm going to show you those flows. Remember I showed you that spike? So moving along, tickety-boo, spike downwards, and then continuing. Okay, now I'm going to show you a picture like that for about 4 different countries. And you tell me if you're seeing that pattern for each of these countries. So heads up. Question? Okay. You see I'm getting all excited here, right? I need to... Okay, so that's Korea. That looks like it. China, Argentina. It's not quite as... Whoa. Mexico up? Inflows? So there's some confusion here, right? What we thought we saw, and everybody was complaining about, it doesn't appear to be uniform in terms of the experiences. I can show you another dozen countries in that emerging market space, and you'll see similarly interesting and different things. Could you guys see them in the back? The different patterns of reactions? Okay, so here's what I took from this. The tapering talk was unexpected, and it was a large negative impact. It was surprising. And it seems that different countries were affected differently. And so, to me, the following questions came to the fore. Like, which ones were hit hardest by that Fed taper talk? That Bernanke and aftermath taper talk. Why these, not others? And is it related to fundamentals? A lot of people are talking about fundamentals. That's like IMF, World Bank speak for something. Maybe it's industrial organization in the markets. Maybe it's something else they've got in mind. Okay, so I've got some thoughts on what happened in 2013. Okay, I'll call it a biased perspective. Pause. Any questions? Anybody want to follow up on anything they saw or were confused about? All right. Ready? Okay. Here's my biased perspective. So during 2013, when all of this is happening, I'm on sabbatical leave, writing the book that represents my research for the preceding 20 years. Busily away. Half of the year I was in Cambridge in England, half of the year I was in Washington, D.C. at the IMF in the research department, hanging out with those guys. The book was already designed and planned and being executed when all of this chaos is going on. Okay? This is coming out and forthcoming in Oxford University Press. I mentioned June 2nd. So what is this book about? So here's what I was originally trying to do. Okay? And did. Okay? So it's called a rigorous, comprehensive, and practical framework to measure what you might call the fundamental risks of investing in emerging markets. This is a book that's not an academic book. It's written for the industry, people out there in industry, who I think are confused about what people think about when they think about emerging markets and how they think about it. I'll give you my definition, philosophical statement about what an emerging market is in a second. It's rigorous in the sense that there's a lot of academic research that goes behind this framework that I developed. It's comprehensive because I believe that it's not so simple as to call something a country emerging versus developed. The answer should be based on what? There are, I think, different dimensions in which countries differentiate themselves. They're not just simply above or below the line based on some sort of, okay? And then it's practical. So what I do is I actually develop a scoring system. I literally put country names down on a page, and I put scores beside them. And they're not my opinions. What I do is I take existing research and data, lots and lots of data, and I develop these scoring indices using very common, well-known statistical techniques. I call it hands above the table statistics. No funny business, no opinions, none of my opinions. I'm harvesting lots of people's views in the research and the data and letting the data talk, okay, to reveal it. It's used a technique called principal component analysis. Anybody from statistics in the group here? No, that's fine. So, and then what I do is I build these indicators using this technique with all of this data for not just the traditional 33 emerging countries that you might include, like according to Morgan Stanley or JP Morgan or whoever. But I also throw in 24 developed markets because I want the data to talk fully through the spectrum of all countries for which we can get this kind of data. And then I try and take it for a test drive to explain other things. And I'll tell you about that in a second. So, why bother writing it? As I already mentioned to you, I'm trying to elevate the quality of the discussion that's out there in industry about what it means to be an emerging market. Trying to raise the game in terms of talking about it, what it really is. And here's the actual official definition. I'm sorry that slipped over. That should be like one line. It's actually on the first sentence of the first page of the book. What is an emerging market? Here it is. It's an underfunded, undercapitalized growth opportunity with problems. So the country has opportunities up the yin-yang, but not enough capital to fund them. Not enough of a deep pool of capital to fund those projects. So it's externally dependent on funding from outside, which is great, except the funding is not showing up because those who are willing to supply potentially see problems. And so what are these problems? Those become my 6 dimensions of risks. Okay? So they are underfunded, opportunities for a good reason, because of 6 basic fundamental types of problems. Why bother? Because I just don't, traditionally when people talk about emerging markets, and I've got lots of examples of books that are written that you can go get on Barnes & Nobles, many places, they're always talking about the upside, upside, upside. But the downside is the story. It's not the upside. It's the fundamental risks that keep people away that is the real story of emerging markets. And it emphasizes the multiple dimensions. I also want to stop this talk, you know, Goldman Sachs Asset Management invented this concept called BRIC. You've heard this term. Everybody uses this word loosely. We know what it is. It's those 4 countries. But it's as if there's something special about these 4 countries. But it's like a vacuous clustering of 4 big emerging markets. There's, and then of course everybody, every man, woman, and child wants to create their own acronym, groovy, cool acronym, to catch attention to whatever they're talking about. I want to get rid of all of these. I want people to be talking about the stuff that really matters, and hopefully stop simplifying, oversimplifying what we're trying to think about here. So, and it's useful to try and explain other things, as you'll see. So here are the 6 indicators. Are you ready? So here we go. And these are chapters 4, 5, 6, 7, 8, 9. Okay, so it's like the heart of the book here. So market capacity constraint. I think this is what most people think about when they think about emerging markets. How are we doing? We're still okay. Market capacity constraints. Market cap to GDP, the size of the market, size of the financial markets relative to the size of the economy. If it's too small, that's the source of underfunding or undercapitalization, right? GDP per capita, the size of the bond markets, the vibrancy of the markets, how actively it's turning over, the trading volume, trading activity, the number of new companies or new bond issues that are coming to market, replenishing the ones that, you know, sort of fall out of the markets. This is all a sign of the vibrancy of vitality of a market. So that's the logical first one to include. Sometimes that's all people talk about. Another problem, I call it operational inefficiencies. This is what I call the plumbing of the market. So say you're taking a client's money into a market in Malaysia or somewhere, and you're looking at, worried about whether you're going to ever be able to deploy the money wherever it's intended to go, like investing in the local stocks or investing in the local bonds. So I've got, you know, commissions, transfer taxes, measures of illiquidity, right? The degree to which you might lose money because you can't sell it when you want to and you have to wait. Short selling is a technique where you actually try to sell stocks where you don't own it first. Believe it or not, that's possible. Many countries preclude that possibility. And speaking about plumbing, you know, there are delays in the clearance and settlement systems, as you can imagine, in the global registries around the world and how interconnected they are. So this is all basically the frictions or plumbing, problems with the plumbing underneath the capital markets. It's not the size of the market, but how well it functions. So that's a logical one. I'll speed up here. Your ability to get in, just get in the door. Foreign investability restrictions. As a foreigner, foreign capital, there may be some special provisions that preclude the money from getting into a certain country. This typically is prominent in emerging markets. Like, for example, pick one here. Currency convertibility restrictions. Your ability to actually take money that you've made, you know, harvested profits with whatever investment you made in a country, and your ability to repatriate it into your home currency. These restrictions pervade in the country. Corporate governance problems. I call it corporate opacity. This is a really big one. You know, the fact that you have uneven accounting standards or potentially large, dominant, controlling block holders that are present in the share ownership of a firm that makes it hard for you to come in and invest, even if you wanted to, and let alone trust who that block holder, maybe a family member, you know, it's a family-owned company or a dominant, maybe even the state might be a large block holder in a corporation. That all makes you just a little bit queasy as a foreign investor coming into a marketplace. So that's another one. Limits to legal protection. So imagine that you've done an investment, you're taking your client's money into a country, and suddenly something has gone wrong with the plumbing or with respect to the currency convertibility. What's your recourse? Where do you resolve disputes? Well, you've got to rely on the legal system, and you might want to try to capture the quality of the legal system towards being able to take your client's money back. And then finally, the one I'm sure you guys have thought about when you were answering my questions off the top of the hour, political instability. A lot of dimensions. Dimensions including not only government effectiveness and regulatory burdens, the things that people talk about, but also corruption. This is the Heritage Foundation's Freedom Index. You can see there's a whole host of data that go into my six little buckets here. And what I do, I'm going to give you some slides here. I think I'll skip over them quickly. Is I use this statistical technique to take data that's inside each of these buckets and compress it into a single index, standardized index score, so you can rank countries and see how much better some countries are than other countries. Quite cheeky, huh? Can you imagine the trouble I'm going to get into here? So here goes. So this is what we do. We take harvest the research that's out there. So I'm not randomly cherry-picking data. It's data that others have shown that are important. I combine it with other useful data, and then I synthesize. That's basically what I do. And I do that in each of the 6 chapters. I was going to show you an example of one of these for the plumbing one, the one on operational efficiencies. And here are some of the research studies that I used, or data from the World Bank's global payment systems. This is just to give you a taste of where some of the sources. This is a firm that creates data on trading costs around the world, so I use some of their data. These are some research studies. There's another study on trading rules in different markets around the world. This one's looking at proxies for liquidity. Heck, I even use some of my own stuff that I've done. This happens to be on liquidity around the world. So some of my stuff, some of other people's stuff, some independent data sources, all compressed in here. And then here's some examples of some of the data that we showcase, right? There's some of the data that I'm showing you. And for different countries, they have some averages. And then what I do is I throw it into this secret bag called principal component analysis, shake it up, and out come some weightings across the different components. And they're the ones that are put together into this index. And it's a very conventional technique. Some of them are big winners. Some of them are big losers. Including some of my own stuff, sadly, comes out as a loser. So, I'm willing to share that with people. Even some of my own stuff was in there and it didn't work. That's okay. Skip that. So here's how the book is organized. I set the stage, I build the indicators, and then the third part, which I'm going to talk about next, the last bit, is I try to validate them. So I build these things, and then you say, so what? So are they good for anything? Can they explain anything? About the ways in which people behave or not. And so let me show you some of the indicators so you can, for your home country, wherever you might be from, you might get very angry with me, but at least you can see what I'm doing. Okay, so this is a spider diagram. I show these a lot in the book. See how I've got my 6 dimensions here? Okay, so in each of the 6 dimensions, it goes from the center and radiates outward. It's also called a radar diagram. If you're in the center, negative scores, bad. Out. Positive scores, good. Okay? So what I've done here is shown you the typical emerging market on these 6 dimensions. The median scores are the blue in the middle, in the negative ranges. Shocking, as you would expect. Red, typical developed countries, more in the positive ranges. But what you should take away from this is how different they are kind of depends on what you're talking about. You can see that when it comes to talking about limits to legal protections, remember that legal recourse thing, the dimension of difference here is a little bit murkier between the two than, for example, when you're talking about differences in corporate governance, disclosure strategies of corporations and things like that. Same with the plumbing stuff, the operational efficiencies. Bigger differences here, smaller differences elsewhere. Guess what? You can do this by country. So there are the 6 radar diagrams by country. Remember, negative scores in the middle of the spider web, bad. The further out, better. If it were equally important, the 6 dimensions, you'd see a nice hexagon, right? A nicely 6-sided hexagon shaped somewhere inside there. And you can see it's hardly that for any of these countries. You can build one of these for every single one of the countries and study it. So now you can see, hopefully, the practical dimensions of all of this. So you look at a country like Brazil, some people might care about Brazil. Not bad on some dimensions, kind of equal. Russia over here, where do they drop the ball? Where do they drop the ball? Corporate governance is terrible in Russia, relatively speaking. But not as bad as China gets the horrible score on corporate governance standards. And this many scholars have written about with respect to. But in terms of China, look at its market capacity constraints. That's the size and vitality and vibrancy of their markets. That's almost as good as a developed market. So I remember who I asked about China. I asked you about China, and you said, well, you thought about sectors, and I'm trying to change your mind about what to think about, but you're right, it's a little bit uneven. On some dimensions, China falls down, but on other dimensions, China is not falling down, right? In terms of the operational efficiencies, that's comparable with many developed markets. So that's how I want to broaden people's minds, to think more broadly. Now, I'm going to show you the average score across the 6, even though I just told you don't do that, okay? There are different dimensions, so don't do any averaging in your mind, but people like to do that. So I'm going to show you, this is the bar chart of the scores of the typical 33 emerging markets, and there's your median developed one down there. And you can see that these bars are mostly in the negative ranges, and there are some interesting, there's some nice dispersion, difference, it's spread out a bit, and there are some interesting jumps. Right? Venezuela, terrible, the worst country on the list. But what is really interesting is that there are some of our countries here. Did I ask about South Africa? I think I did. I think the verdict was emerging, but I would say hold your horses there. Not so sure. On some dimensions, it carries up to be actually on average in the positive ranges. Not quite a typical developed country, but not bad. Okay, so you guys see where I'm going with this? The practical dimensions of this? Now watch this. I should stop soon here. This is the, I need to set it up. So there's the rank ordering of countries by the average score across my 6 fundamental risk indicators. Okay, so there's your rank order. Now I'm going to show you each of the component scores one at a time, but I'm going to preserve the rank ordering of country names there. So the names are going to be the same in the same order, but I'm going to allow you to see how different scores are that go into that overall average. And you're supposed to see, wow, this is not the same thing. So there's operational efficiencies bucket. There's the foreign accessibility. That one's interesting because it's kind of even more compressed. I would say that's almost even, right? And here goes corporate governance. Very much not correlated, right? There's the look how compressed that is towards 0. Limits to legal protections. Now this one I've cheated. This is the political risk one. I've resorted it by political risk in 2012. Some of these indicators are varying over time in interesting ways, some less so. This one does vary over time using the various data components that I have here. So watch this. I'm going to now keep the same names here, resorted the names for political risk, and I'm now going to go and show you in the dynamic graphic each of the component scores and how they're changing through time, going backwards every 2 years, all the way back to 2000. So you're going to see 6 pictures here. So watch. You tell me what you see. So what did you see? Reactions? This is interesting, right? So the rank ordering is more or less steady, but not the same. There are countries that are coming in and out with better scores and weaker scores depending on things that are happening in their political environment, right? And that's exactly, I think, what you would expect. So I'm going to do this really quickly because I've gone way over time. how would you judge whether this is all garbage or useful? So here's what I did. What I did was I collected data from global institutions around the world. And it's data that we have available here at Cornell. And basically, each institution, like let's say the New York Municipal Employees Retirement System, with their $68 billion fund, they decide that they're going to take about, I don't know, 10 billion of that 68 billion of retirement money and invest it overseas. And then the question is, of that 10 billion of the 68 billion that they invest overseas, what fraction of that do they invest in emerging versus developed markets? In France versus Italy, in Malaysia versus South Africa. And so I collect up all this data on holdings, say, as of the end of 2012, and I try to evaluate how much collectively they are investing in each of these countries. And these are institutions literally from all over the world, conditional on their investing outside of their home country where they put their money. And what I do is I try to evaluate, we're talking about 6.3 trillion. And what I do, and I also use US data, specifically US data, just to sort of validate it. And then the question is, if collectively institutions are putting about, I don't know, 4% of their money in China, is that about right? So what we do is we typically judge whether 4% on average allocated to China is right by evaluating the relative size of China relative to the world market. So China turns out to be about 11 or 12% of the world market. So 4%, you'd think that's a big deal, but in fact, it's sort of 8% less than what we would have thought. We call it an underweight. Some countries, of course, by definition, represent an overweight. I'm going to show you a picture here of the relative over and underweights among emerging markets. Typically, you guys can see, most institutions around the world, including here in the US, underweight emerging markets relative to their importance. We're getting there, but we're still way, way, way behind. But some countries are relatively more overweighted and others are relatively underweighted. You can see the variation here. My thought is, gosh, I wonder if some of these risk indicators that people use can explain why some countries are relatively overweighted and underweighted, and the answer is, not bad. Okay, so that's the last 100 pages of the book. Not bad, okay? And I'll skip that. I even do it for the US, and it's also not bad. What's really interesting, I won't show you the results. What's really interesting is the traditional indicators like market capacity constraints and accessibility restrictions that I think come to fore for many people when they're thinking about emerging markets are not even as important as things like political instability and governance. Those turn out to be really good and work well. Okay, and this is just showing you statistically, China's a huge problem. It's a huge underweight for the rest of the world, and not even my wonderful indicators can come close to explain the China enigma. But anyways, I'm skipping through this. Closing it full circle. So I'm writing this book, I'm performing the analysis, I'm validating the analysis, and chaos is reigning in emerging markets in 2013. So this became what I call the bonus chapter, chapter 11 in the book, where it says, gosh, we actually have data on the countries, you know, when the taper tantrum hit, and it surprised everybody, and some countries got affected more intensely than others. I was sitting there stroking my chin wondering, gosh, I wonder if my risk indicators can explain why investors race to the exit so much more intensely in some countries like Indonesia and India, and yet we're racing into countries like Mexico. And so the results in chapter 11, my bonus chapter, I call it bonus because I think of it as kind of an out-of-sample prediction that dropped out of the sky for me because it was happening while I was writing it. Not bad is the answer. Not bad in terms of explaining that. So let me stop there. I hope we still have some time for questions. I haven't intimidated you guys. I call it a quasi-natural experiment. And this is all meant to show you, yes, not bad. I'm happy to leave you guys with the slides. But so here's the conclusion. Have we cracked the emerging markets enigma? By the way, can anybody guess? This is a good test. Can anybody guess where the title comes from? Cracking any of you guys go to the movies? Are you guys working too hard to go to the movies?
I didn't see the movie.
What am I thinking about? Huh? Benedict Cumberbatch, right? Keira Knightley, The Imitation Game. So where I was in Cambridge was about 50 miles away from Bletchley Park, where all of that happened. And I went to that museum there that's now there before the movie, okay, before the movie. And I just got completely fascinated by what was happening, cracking this Enigma code of the German Nazis. And the 3,000 people that were involved in doing that, Alan Turing and the invention of the first computer and all that stuff. I encourage you to go there. That's where I ripped off the title. But for emerging markets. So, have I cracked? One of my reviewers says, would it be okay if I called you the Alan Turing of emerging markets? And I said, I don't know. I think that would be okay. Didn't use it, but I don't think I've cracked any emerging markets Enigma code. But these indicators, I think, are pretty helpful to try to explain some things and hopefully clear people's minds about how to think about emerging markets, what's really different about them. So, let me stop there, and you guys, come on, ask me some questions. Engage here. React.
Okay, so
what's missing? What am I missing?
I suppose this kind of goes along with something you're missing, or I guess my question is more along the lines of, it seems like you have a lot of kind of research and data into like the 6 risk factors.
Yeah.
Is there kind of a common criticism of the way you put together the rating?
Yeah.
And what is it?
Yeah. Well, so you're inviting me to criticize myself.
Exactly.
Thank you very much.
Yes,
That's very polite of you.
And then you can
but I think it's good. I mean, you guys should know that I'm not averse to this. So there's an objective function in the statistical technique called principal component analysis, in which the weighting system kind of comes out of it. And what the weighting system does is it's objectively trying to maximize the unconditional variability in the index scores, seeking maximal dispersion or separation among the countries that's possible. That's the objective function. And then there are some constraints for solving that objective function, and out drops the weights, and out of that comes the index score. So you'd say, well, what does that have to do with anything? To do with what you're trying to explain. So here's my logic. My logic is, and that's a reasonable criticism, right? You're maximizing variability, so maybe you're maximizing noise or some interesting signals. I don't know. That's why I take it to the data in the end. But some people would say, what's the economic rationale behind this statistical objective function? I think it's a good criticism. My argument is what I like about what it does is that it's objective. So unlike Goldman Sachs, unlike Morgan Stanley, unlike many of the S&P, the global indices, they all have this sort of secret war room in the back where they decide which country gets promoted or demoted, and we're not exactly sure what their criteria, and it's all very proprietary, hush-hush, and so on. For me, I put it right out there. I even show you the code, I show you the scores, I show you the data, I lay it out there, and we can actually have a conversation about that. So I like that. So you invited me to criticize, there it is, but I think I have a decent answer for it. But market test, right? Let's see if anybody finds this interesting or useful. So, somebody else, please, come on. Yeah.
So then, does your statistical analysis apply inherent weightings to each of the risk factors, or do you just equally weight them?
Oh, good question. So you notice that I apply the algorithm to each bucket.
Right.
And out of it comes a score, and then we have 6 buckets, as if they were equally important. I never do it across buckets. So in my mind, I'm keeping the logic of these things separate. So thank you. That would be another good answer here. What is your rationale for allocating these data into 6 buckets? And the answer is, that's where I have my hand in the cookie jar a little bit. I'm doing some allocations here that I think are reasonable. I'm perfectly willing to readjust it. I do talk about this as a potential criticism in the back. That's good. That's a good question. That's a really good question. I could easily see people saying, this component over here, you stuck it into bucket 5. That could easily have been in bucket 2, and they might be the same thing. Okay, that's fair. That's fair. Yeah, please.
One thing I was
about was the time sections.
Time?
Time, because I can
Yeah.
assume that when you were like evaluating countries, there was only specific portions. Like for example, when your data could have focused on when Egypt was very instability,
Right.
and then the political instability score was higher than normal the past like 30 years.
Terrific question. So, admission, the book focuses on 2012 and 2013. That's what I showcase. But as I snuck into the slide presentation, do you remember the political instability one? All of these scores are varying through time. It never made it into the book, but all of that data on holdings I've analyzed since the book closed last 6 months ago. I've expanded the analysis to the entire panel of countries and years. And I'll tell you, as good as this worked, and I was, duly humble, it is awesome when you build it out in one category. It works even better than I show, but that's not in the book. When I put up the website, the book's website is going up soon. For those who buy the book and I guess get some sort of secret password, I'm going to furnish all of the index scores for anybody who wants to take it for a test drive to explain whatever you guys might want to take it for a test drive for. So that will be available to the marketplace. It's just that all the index scores by year. But the time, good question, right? Because time is really important. And Egypt was in trouble in 2011 where they were having the uprising in Tahrir Square and all that sort of thing, and the turnover. Those should be featured in the scores, right? And they are to some extent. But you need to dig down one layer to kind of see what are the components. It's not just about turnover. There are other things that go into the political system, for example, and how you measure the political system. I could talk more about that if you guys are interested. But please, nice and loud so everybody hears.
Could you please speak to the risk caused by outside investment due to the lack of commitment of that foreign investment?
Yeah.
And how that would weigh against the internal factors?
Right. So I don't know about the last part of your question, that it's weighting against it. But does it make sense to you that many of these countries are starved for capital relative to their population bases, relative to the potential that might be there? Does that make sense? Right? And they're just, it's just that they're relatively newer countries in terms of their capital base, their accumulated savings relative to developed countries like the United States or Europe, right? And so the question is, basically what we're talking about here in the end is their U.S. investors are ever increasingly more so looking for opportunities outside of their borders for their investments for whatever reasons. And these countries are counting on it because they need the capital. There's just not enough accumulated capital inside. So that's how I think about this. I guess it's simple, maybe too simplistic a way to think about it. But so we have nothing blocks the free flow of capital except for some restrictions, buckets 1, 2, 3. But there's also softer constraints. I use the word softer constraints. So imagine that there's no penalty for capital to come into Indonesia from overseas, from Europe and the US. There's no currency convertibility restrictions. None of those things matter. The door is wide open for money to come in. It's just that they don't come in because they are inherently concerned about other things that might impede their ability to take whatever profits they harvest back home, like governance profits, like money being stolen out of the till, things like those, things like that. So I think I danced all around your question, but did it fill in the logic a little bit for what I'm talking about?
So could you just clear up a little how you actually get quantitative data on things that are very qualitative, and also if it's an emerging market, it's a lot harder to get real and useful data from it. So how do you?
I need to work with undergraduate students more. You guys are asking super smart questions that industry people, when I presented this to, aren't even asking. Fantastic. There's got to be non-quantitative, qualitative aspects that make you nervous about potentially taking clients' money into a country, right? one of the weaknesses of this project is the fact that these are quantitative based. So how do I deal with that? Give me advice. How do I advise on the qualitative dimension? My answer would be, if you think these qualitative dimensions matter, by all means, use them. Let them guide your decision making, but you need somewhere to start. You need some sort of framework from which to start towards applying some sort of qualitative judgment factor to adjust and allow for an overweight of, for example, Oman, and underweight a country like Korea. It's perfectly within your discretion to do so, and there may be some systematic aspects that I've simply missed that is quantitative, but let's call it qualitative. I think you need a starting point. Mine's a starting point framework, and then let's talk, right? Is there something in mind that you had, just out of interest?
Well, I'm also curious though, so an emerging market, the data itself, understanding their accounting standards, it's very murky. So
Right.
how can you make any real basis, like use that as a basis if you're not even sure the data is reliable in any way?
Great comment. One of the weaknesses, again, in my apologies chapter, chapter 12 is the last chapter. I call it my apology chapter. All the things I don't do. In there, I talk about the fact that I need my whole mindset, and frankly, all of my fellow scholars' mindsets may be skewed by the fact that we can only use the data that's available to us to use. And we may be missing something that is terribly important. And I allow for that possibility. I don't know how to deal with that, except to wait and see if the framework stands the market test, right? It's got to await the market test from here on out. But yeah, absolutely. I talk about it, but I don't do anything about it. I talk about it.
The solution be going into a specific country and actually trying to fill out all the things that you think could be related and then using that as a test.
Yeah, I think that's reasonable. I'll tell you what, I mean, thank you. It's a great question and a great comment. And maybe that's the way we have to wait for it all to shake out. For what it's worth, remember I mentioned 33 emerging markets? Well, it turns out there are many more countries than just 33 that would be available. And the reason I stopped there is because I have most of the data that I would use for those 33, which plays into your concern. So I've hired an undergraduate student. He's not here. I don't think he's here. His name's Andrew Rivera, smart young guy. Came and pitched to me. I hired him. And what he's going to do is, are you ready for this? He's going to build out, in spite of the fact that there's a lot of uneven data in the frontier market space. I mean, we're literally talking about Omans and Nigeria's in the developed set, but countries like Niger or Equatorial Guinea, countries where there's a lot of unevenness with the data. He's going to build out the data for those countries, and what we're going to do is try and reverse engineer them into this framework to see how they would do. I think it's a cool project. It's sort of the next iteration. I don't know if we'll get anywhere, but we're going to try. How are we doing on time? Any more questions? One more. Go ahead.
Did you find any statistical, like maybe anomalies about regions, like maybe where countries that were grouped together?
Geographically?
Yes.
Didn't do it. Didn't do it in the book. However, here's what I would say to you. Do you remember I told you that I've taken the data now into a panel framework across years and across countries? So one of the things I do is measure not the over and underweights, but I look at the country pairings. So the money comes from somewhere and goes to somewhere. And I measure and quantify that over and underweight depending on where it's coming from. In there, traditionally, research has shown that geography, geographic distance, is an important pull on portfolio flows. So the fact that Mexico is next door to the United States means that disproportionately US investors are going to overweight Mexico. Okay? So in the new stuff that's not in the book, that builds out the data in a panel framework, I control for geography. It is a fantastically important factor in explaining things. But, good news, good news for those of us who care about this book, my stuff adds important explanatory power over and above things like geographical distance. So you're thinking in the right way. Now, I don't really understand why geography and geographic distance matters so much, but thankfully it doesn't undercut the institutional variables. I call these institutional variables. Thank you, guys. Great questions, by the way, and I'm so pleased I came. Thank you very much for listening, and watch for see if any media hits, and now you know where it came from. So, thank you very much.